Hello and welcome to Merk's webinar on the outlook for gold, gold miners, and Merk's management of the ASA Gold and Precious Metals Fund. On today's call, we have Merk's President and Chief Investment Officer, Axel Merk, and from the portfolio management team, Peter Miletus. At the end of today's presentation, we'll have a Q&A, and we encourage you to enter questions in the Q&A box on your screen. Please also note that this presentation will be recorded and a replay will be available in the coming days. With that, I'll turn the call over to Axel to begin the presentation. Axel?
Thank you, Nick. And Nick, by the way, is also part of the portfolio management team. He'll play the master of ceremonies today. Peter, I'll introduce later in more detail when we talk about ASA more specifically. You'll hear him talk about the gold mining industry and what we're looking for in that, and really talking about gold miners rather than, quote unquote, just gold, interest rates, currencies, and so forth, as we usually do. That's a new feature on today's webinar. There have been several requests. We talk about gold miners more specifically. And all that said, I will put this into the context. So the first session or section, I will talk about the price of gold, what we see in the gold space. Then we talk about the gold mining space, and then more specifically investing in the gold mining space and the closed-end fund that we took on earlier in April, and as far as managing it. Some of you are very familiar with ASA. Some others of you have never heard of it. Some of you are very sophisticated in this space, and others are not as sophisticated. So we'll try to strike a balance here. As Nick has pointed out, feel free to ask questions along the way, and of anything that you don't understand or that you want us to expand on. If we don't get to it during the webinar, we'll cover it later. You just saw some disclosure. I hope you read that in detail, and you'll see some more disclosure along the way. So let me first start here, jumping right in with the gold argument in itself. And I will try to give you a little bit of overview of a few different reasons why investors may consider gold. And one of them here, as you can see right now, is the Fiscal Outlook in the US. The average deficit that's projected, and these are based on the Congressional Budget Office, are significantly higher than those we've historically had in the US. Some people say these are not sustainable. Indeed, several reputable politicians, leading both Republicans and Democrats, say that we need to have entitlement reform if we want to have deficits sustainable. And of course, if we don't have them sustainable, the odds of devaluating the purchasing power of the dollar are increased. And in that sort of environment, the price of gold may do well. And so that's one argument. The bit of a challenge with the fiscal situation is it's very difficult to put a correlation between the deficit and the price of gold intuitively and historically speaking compared to other countries. When deficits have become unsustainable, that has been bad for the currency, good for gold priced in that currency. Remember, gold doesn't really change, or doesn't change. And so it is something mostly to keep in mind as a background. Now, one of the main things people talk about why they want to own gold is as a hedge against inflation. And if you've listened to any Fed official or most Fed officials in recent months, they not only say that there is no inflation, they also believe inflation, or they argue and say that inflation has been below the 2% target over the last 10 years. And importantly, I say importantly, I was at Stanford at the Hoover Institute at a monetary conference recently, and the takeaway I had is not only do they say that inflation has been below 2%, which is their target, but they also say that that is a problem. And that's a big difference, right? It's one thing to say, yeah, inflation has been low, but we'll still monitor it. But if they say inflation below 2% is a problem, that means they might have an incentive to make sure that inflation is going to move higher. And I just put that there in context. On this chart here are the historic inflation readings. The core PCE, that's the grayish line, is the official Fed target. and then there are some other inflation indicators, but they all, I mean, they have come down in recent months. So that's one thing I'd like to point out. And let's look at this in different ways. There are various ways in which one can look at inflation expectations. This one here is the so-called break-even rate, and it's basically the difference between the nominal bond and the inflation-linked bond of the same maturity. We look at the 5-year and the 10-year break-even, and so basically that suggests on a 10-year basis, inflation expectations is in that neighborhood. And when, as you can see here, inflation expectations have come down a little bit. Now, there are some other ways of looking at it. Here, let's put it in the context of the price of gold. Note here that the axis is inverted for the price of gold. And the reason we show it this way is that historically, one can argue that there is a relationship between the price of gold and the 10-year rate. And the argument here is that if you get compensated for holding cash, or in this case, holding a 10-year note, then it may not be worthwhile to hold gold, which does not compensate you. It's just a brick, right? And so when interest rates are higher, then all else equal, you might want to hold the bond. And obviously, that relationship doesn't always hold. And especially here, if you look at recent, you see some trends sometimes going in the opposite directions. There are various reasons why bonds may be moving, and that they don't always affect the price of gold. We'll talk about the price of gold relative to other things here in a moment. I just want to put that into context. But the one chart I want to show you, and those of you who have followed our webinars more have seen me use this chart before. This is the price of oil and 5-year forward inflation expectations. Now, here we use a different metric. This is a direct one taken from a market, from a tradable derivative. But the story is the same. And what I want to show here is that when the price of oil moves, inflation expectations move. Now, on the one hand, you may say, sure, when the price of oil moves higher, then inflation is higher. Well, not quite. These are 5-year inflation expectations. So the derivative that's shown here suggests that 5 years out, the analyzed inflation will be at 1.91%. You cannot tell me that based on the price of oil movement today, inflation in 5 years is going to be X, Y, or Z. So part of the reason I show this to you is because there are lots of quirks like this in the data, and maybe this is the best we can go by, right? I mean, there is an argument for that. But ultimately, let me go back to this so that we don't just get lost in the details of the charts. As I indicated before, my view is that if you have high interest rates, then cash might outperform, right? Otherwise, gold may do quite well. And part of the reason I show Yellen here, well, that's when we first created this chart. But back to what I indicated earlier, Yellen used to be at the San Francisco Fed before she was the Fed chair. The current president of the San Francisco Fed makes an argument that, in my view, is a bit extreme. But she says that, well, next time we have a recession, we may have to take the interest rates down to 0. It might be very difficult to convince the market that we are serious about our 2% inflation target. And that is why, according to her, now that the times are good, we need to allow inflation to go above 2% so that then we're credible when we go back to 0 that we're going to move back up there. If we only say that we're going to move inflation back up to 2% in a recession, it will not be as effective. And so I just throw that out there. Now, I have a big problem, by the way, with all these arguments, because there are clearly reasons why inflation has been lower in recent years. The financial crisis that we had, the most pronounced one. And then there's an argument about globalization keeping inflation down. I get that. I agree to that as well. Demographics, one can argue that. There is some indication that demographics do play a role. But the one thing that I think that is neglected in this, and why I have a problem with the story that says this time is different, is that when you have unemployment that is at near record low levels, when you have wage growth that's already significantly above 3%, when in my view, when everybody agrees, not just in my view, when everybody agrees, I believe, that there is a limited number of people you can pull from the sidelines into the job market. When in that sort of environment, you generate more jobs on a monthly basis that leave the job market, at some point you're going to cause a problem. Now, nobody knows when that problem is going to be caused. Is it going to be in a few weeks, or is it only going to be in a few years? In my view, we are not there yet, but in a few months, we may have a problem. And then now we have higher wages translate to higher productivity, everybody's happy. But if we have problems pulling in from the sidelines and we are still on the accelerator, or as the Fed had said, at the lower end of the neutral range, if we're not on the brakes, then we may well have some dislocations and have a more significant issue with inflation. To me, the Fed is way too complacent about that issue. Part of it is because all the folks who have said, oh, inflation is a problem, have been quote unquote wrong for so long. But to me, that doesn't make it any less important to worry about it. And so all that said, let me put some of these things into context. You've seen charts like these before. I put here the purchasing power of the dollar since 1970 into here, simply because after 1970, after Nixon went off the gold standard, gold was freely traded, and that's why I think the comparison here to the early 70s is relevant. And so we have lost about 83% of the purchasing power of the dollar. Now, granted, when you invest in cash, you do get interest along the way, but still a dollar today buys less than it did at the time. And to put this into context, and the gold, just the price of gold, has had an annualized return of 7.5%. And that obviously was a little higher at the peak here. We had when the price of gold went up significantly a few years ago, has come down since. But over the long run, gold has been a reasonably good investment. Now, the volatility in gold is reasonably high, at times higher than that of the stock market, in the medium to long term about the same. But many people say, well, I want to invest in gold with hindsight because it was good, but tomorrow I don't want to invest in it because this brick doesn't give me any yield. Well, maybe it's not that gold is really such a precious investment. Maybe it is that cash is not such a good investment. And ultimately, the question is, why does one hold gold? And one of the reasons is a diversifier. And with that, let me go here to the next argument as to why people may want to have gold. It is about the correlation argument, right? The correlation of the price of gold versus the S&P 500 in the long run is zero. I've been quoted in the media as indicating that and here particularly is with a 52-week rolling average, it's minus 0.25. So depending on exactly how you use it, sometimes it's zero. I think based on monthly, here it is minus 0.25. A correlation is obviously the relationship that two assets here, how they move together in tandem. And when I say that gold is the easiest diversifier, it's not always the best diversifier because it's frustrating sometimes. Sometimes it moves with the other things you hold, sometimes against it. But part of the beauty of a diversification is that it does move differently, right? And so that's just to keep in mind that gold does have a correlation. And the one thing it has as well, it's in S&P bear markets. So when the S&P has gone down more than 20% since the early 70s, in every bear market, with the very notable exception of the early 80s, gold has done quite nicely during the S&P bear markets, with the early 80s being the exception. And the key difference in the early 80s was that Volcker, the then Fed chair, increased real interest rates quite substantially. And so if you're concerned about real interest rates going up quite a bit, then gold may not be a good diversifier. And one other thing, I don't have that here in the charts, is one argument I make as to why people use gold as a diversifier is because of the volatility that tends to happen as interest rates move up. As equity markets get more highly valued, you have a greater discounting of cash flows, and that creates a volatility where people are looking for a quote-unquote safe haven, and gold not having a cash flow isn't quite as prone to those sort of differences in valuation just based on the discounted cash flow theory, if that's what you want to apply. And so that's a kind of a technical explanation or academic explanation as to why gold might be outperforming in a bear market. And then, of course, people often cite geopolitics, and clearly when there's uncertainty around the world, gold has historically often done well. One of the things, though, you have to keep in mind, or I'd encourage everybody to keep in mind, is that people get used to crises. We get used to, terrorist attacks. We get used to them, as horrible as they are. Usually when we are faced with a completely new type of shock, that's when we get a more sustained rally. And markets have gotten pretty good, in quote unquote, in absorbing even reasonably good new shocks. Here, this is an old cartoon, and I'll let that stand as is. I want to spend considerable time, and that's why I'm moving on here to, as a transition to talking about gold mining companies, about how one can invest in gold. So I talked about gold, the price of gold, and obviously there are various ways of being able to invest in gold. And historically, the most common one was, well, you buy a coin. The advantage of a coin is that you're not tempted to trade it every 5 seconds. The famous coin under the mattress, right? You don't trade it as much, and that imposes some discipline. And by the way, none of this is investment advice here. I'm just giving here a few pointers. Over the years, several physical exchange traded funds have come to market. We manage one of them, and I need to say that this webinar is not about our physical gold ETF. For regulatory reasons, we have to keep those separate. So if you want to know about it, we can approach us separately or look on our website. But and then we can explain to you why we believe ours may be better, or whatever it may be. But we are not going to be able to talk about our gold ETF here in this webinar. The next section is the gold miners. And the gold miners are really not just one group, are several different groups. And because we're going to talk about gold miners here more specifically, I've listed several different categories, with the exploration companies really the ones where you're literally looking for gold. And those are the most speculative investments. Because if you quote unquote strike gold, well, you can go to the next step. You can develop the mine. In both of these phases, it's very important to manage your cash flow, because it is very expensive to mine the gold. And then to kind of jump here ahead, the large cap mining companies, the big established companies, they're the ones who have a portfolio of mines. And obviously, even there is obviously something in between where you have the single the companies that have a single mine, and some have multiple ones. But then the larger you go, the less volatile they get as far as the share price is concerned. Now, any of these companies tend to be more volatile than the price of gold, with obviously the exploration companies historically being the most volatile ones. And they have some pros and some cons. Peter, in a minute, is going to go into some of those. And then the royalty companies, Peter may touch on those as well. That's kind of a hybrid, so to speak, and Peter can explain a little bit on what those are. And then to invest in them, obviously, anybody can invest in specific gold miners, or there are investment funds available, and there are mutual funds available, and closed-end funds available. Now, mutual funds are the ones that many of you are familiar with, where you can kind of buy shares, and then more money gets into the fund. A closed-end fund, some of you are familiar with, ASA, we'll talk about in a bit, is a closed-end fund. And basically, a closed-end fund does not offer share on a daily basis. And a closed-end fund tends to trade at a discount, or maybe as a premium, versus its net asset value. And that creates some interesting dynamics that we can go into. And then I'm not going to talk too much about paper gold, but obviously you can address investing in gold using derivatives. So with that, let me pass it to Peter, and then he'll discuss each slide here as a little bit, and I chime in just briefly, and then advance to the next slide. I'll give a more thorough introduction to Peter after you've got to know him here a little bit. But for the time being, Peter, if you want to take the slide and tell us a little bit about the mining space.
Sure. So historically, as Axel mentioned, there are numerous types of companies that you can invest in on the equity side that give you access to mining exposure. Those being the royalties, and then the large cap and mid cap mining companies. This slide here, what we're trying to show is the relative performance of each sector within the gold mining space in up and down movements in gold. And this is calculated as a beta, which means the move relative to the gold price. So the royalty companies, what they do is they have royalties and streams associated with the mines around the world, and they generate cash flow from the production of those mines over the year. Historically, they have been known to perform less aggressively with the mining companies when the gold price is moving up and down. Just to be clear, in this slide, the way this was calculated by CIBC is over the last 5 years, they looked at weekly movements in the gold price. And if the gold price was up for the week, that was considered an up move in gold. And then if it was down for the week, that was a down move in gold. And then they tracked the relative performance of the equities within each of these groups to determine what the beta was over that time frame. Large cap mining companies, which are the largest companies in the sector, such as Barrick and Newmont, have a tendency to move more aggressively relative to the royalty companies and the price of gold over those time periods. And then you have the mid caps again, which are a little more speculative, have a better growth profile typically, and more exposure specifically to the gold price than the large cap and the royalty companies. The reason I'm showing this slide is under the impression that we think that gold is going to go up, we feel that there's better leverage to the mid caps, and moving down in market cap has the potential to improve the performance of the fund. Axel?
Sure, and one thing to add maybe, if you look at this chart, you say, well, gee, on the mid-cap ones, you have better upside and less downside risk. Well, we dug into that a little bit, and these are averages of the specific companies out there, and sure enough, there happen to be some outliers that have done particularly well in the mid-cap space in the down movements. Now, one can shrug one's shoulders and say, hey, these were outliers, but those outliers are more likely to occur in the mid-cap space. The large-cap space tends to be the one space where, quote-unquote, everybody, the large ETF money, goes into. And so while, of course, there's no assurance that this is going to happen going forward, the opportunity of kind of more differentiated performance is more available in the mid-cap. And maybe to just summarize here what Peter said is that if you are, obviously, if you're negative on the price of gold, maybe you want to stay away from it entirely. But depending, if you think, oh, you want to have some exposure to gold, then you can invest in gold, royalty companies, large cap, mid caps, and obviously they each have their own risk profiles. The argument we're making here is that the mid cap space may be an attractive space to be. And so with that, let's move to the next slide. And Peter, if you want to have a stab at this one.
Yep. Okay. In this slide, again, similar to the previous slide, we're trying to show the relative performance of the larger versus the smaller companies. And in this chart, we're using NAV as a to calculate the value of a company. And what this is looking at every mine that those companies hold and doing a discounted cash flow to develop a net asset value of the entire company by aggregating all those cash flows together. And what this chart shows is that a 10% change in the spot price of gold, which will flow through in those models, will increase the price of the NAV of those companies by a relative amount. And the smaller and more aggressive growth companies will have a higher change in their NAV for every 10% change in the spot price of gold. And on the far right, you see the royalty companies where they do not have this significant amount of leverage. And a lot of that comes from the cost structure of each mine and the companies that are associated with that the increase in cash flows drops more of it drops to the bottom line at the smaller the companies go.
And just to be clear, first of all, we're not making any investment recommendation on any one of these companies, but we want to show here more detail that every company has its own risk profile, and as one composes and constructs a portfolio, one can choose as to what sort of profile that one is seeking. Obviously, one can go beyond just what's shown here. Also, just with regard to the net asset value, the NAV, that's model based, right? I mean, you cannot just pull out of it. You cannot just look at the annual report and saying this is the net asset value. It's model based. The particular models that are used here are provided by Scotiabank, and it's really just to give you a sense about the sensitivity that there are very, very significant differences. And in the same spirit here, Peter?
And again, similar type of chart, different way of analyzing the companies. Here we're looking at the free cash flow that's generated, and free cash flow is defined as operating cash flow less capital expenditures to see the amount of cash that each company generates that drops to the bottom line. And then you're dividing that by the enterprise value, which is a way of pulling the assets of the company and really seeing how those assets are being worked by the company. So enterprise value is market cap less the cash, which is just an idle asset, and then plus the debt, which obviously creates increased leverage for these companies. And once again, you see here, smaller, more levered plays are the smaller companies, and you have the royalty companies on the right-hand side that have less leverage to the gold price.
Yeah. By the way, if you want any of these slides, drop in the Q&A box that they like to have a copy of the slides. You can study them in more detail. And to just expand on what I said earlier, the reason that there are several reasons why we're not giving specific investment advice on these companies. One is a regulatory one, that we don't know the specific situation of any one investor. But at least as relevant is that even if we love a company, and if you see in our fact sheet that, or in our holdings reports, we own a company, you are not going to be around when we change our mind and suddenly fall out of love with a company. And so that is one of the key reasons why I would discourage anybody from picking up any particular holding that we have and conclude from that you should hold it, because you're not going to be around when we change our mind. Back to you.
One of the theories that we have is that the gold space has been underfollowed and underrepresented in the holdings of the generalist investors, the institutional investors. And this slide shows the historic level of the gold mining companies as a percentage of the Toronto Stock Exchange, which is where a large percentage of the gold mining companies are listed. And historically, the average holding in the TSX is 7.3%. And is our opinion and understanding, based on the analysis of the holdings of some of the fund managers in Canada in particular, is that they are underweight, significantly underweight the gold miners in their portfolios. So if we can get to historic levels where gold becomes back in favor, and the mining companies in particular, that we'll see, as a lot of the Canadian investors are index-based, and that should help support an increase in the gold mining stocks.
Yeah, that's right. So earlier I mentioned reasons for holding gold may include concern about the deficit, concern about inflation, diversification in more volatile periods, either because of valuations or interest rates, or because of a presumed bear market in equities. But the space itself, of course, is in favor, out of favor as well. And there are several arguments to be made that the space is out of favor. And if you believe to get into a space when it's out of favor, then here's an argument in the Canadian market that, at least for the time being, it is out of favor. And do you want to explain what this chart is about, Peter?
Sure. Again, trying to show the historical undervalue in the gold space using net asset value as price to net asset value, which is a metric that we use in the sector when we're looking at companies. And as you can see, historically, the normal price to NAV is well above 1.5 times price to NAV. Historically, over the last, say, 8 years, that has been dropping significantly as gold has come under pressure post the high of 2011. and this has been one of the longest periods of depressed price to NAV that we've seen in a long time. We believe that as gold comes back into favor, we could be in the get the valuation kick that we've seen back to historic levels, and the price to NAV should rebound. And as the gold miners become back in favor with the increased price in gold.
Yeah, that's right. So a line downward pointing is gold miners less in favor, and the gray bull market areas are those that Scotiabank defines as bull markets for the price of gold.
Mm-hmm.
Peter?
Another valuation tool that I like to use is price to cash flow. The amount of cash that a company is generating from the operating assets in the portfolio, and that is the price divided by the cash flow. Again, we're seeing historic levels where these companies are beginning to, the denominator cash flow is increasing, and the price has either been stable or decreasing as well, creating a very significant potential re-rate to historic levels above 10 times price to cash flow.
And just one thing to keep in mind is there are obviously reasons for those valuations, and some of them may justify those sort of more compressed valuations than others, and we'll go into that in the coming slides. For example, if you have lots of mature mines, cash flow may be good, but obviously if you got nothing in the pipeline, that might depress that a little bit. So there may be reasons for that, but still the prices are depressed, and the following slides, some of them will put some of
just on the back one slide, and just so you know, the difference between the price to cash flow tool and the price to NAV. Price to cash flow is a one-time annual number that you're generating cash flows in, say, 2020, and so you're pricing it off of the 2020 cash flows. Where in the NAV, it's a overall look at the mine over the life of mine, so that gives you more of an asset value over a longer period of time. So there are two different ways of looking at valuation. One is a little more static in the time frame.
Yep, no, great. And then
here, this slide here again goes back to kind of what we were showing in the other slides. Is this is the cost structure of the mines. So all-in sustaining costs and all-in costs are putting all of the costs that are involved in producing an ounce of gold and putting a dollar amount on it, and then you put the margin is created by the price of gold over that all-in sustaining costs. And leading up to 2011, as gold price was increasing, companies were consistently building mines for growth's sake, not for cost containment. So the average, or the all-in sustaining cost for all these mines reached well over $1,500 as gold touched $1,800. Since that period, as the companies had levered up, they started to decrease, look at the cost structure and try and fine tune that. And as you can see, the costs of these mines have gradually come down to a relatively sustained level, or right around $1,000 on average for all the companies in the universe. And if we use the CIBC chart here, they model out all the mines that they can through 2030. And if they continue at the current rate, the cost should come down a little bit, but basically stay right around the $1,000 all-in sustaining cost. The gray line you have there is the combined output of all the companies within that coverage universe. And as you can see, that is starting to decline fairly significantly in 2025. A lot of that is due to lack of investment in new mines, a lack of exploration, and a depressed gold market where the companies have been more focused on returns and cost containment, and less on the future sustainabilities of these businesses. So as these mines decrease, there is a lack of gold being produced globally.
That's right. Yeah, you can save costs if you stop looking, right? Just milk what you already got. Let's put. I think we have a few others in that context.
Yes, and again, a similar type of slide, but again, this is showing the historic relationship between cost and margin. And for the most part, most of these companies try and maintain a fairly they hope to maintain the margins over the life of these mines. Again, this is a total cash number, not an all-in sustaining cost number. So it doesn't include all the costs that take the average cost of the mines up to $1,000. But these are the margins where we're at. And again, we see there on the right that from 2012 on, total cash cost is sort of flatlining, and margins are improving because the companies have been, there's an increase in the gold price, but also some increased production. So thanks.
All right, go ahead.
And then here, this is again this is showing the lack of investment in the mining sector over the last 15 years. Starting in 2005, the company spent a maximum amount of about $2 billion in CapEx. That peaked in 2011, 2012, right around $16 billion as the gold price peaked. And then as gold started declining, the amount of investment decreased significantly as companies were focused. They had levered up, so they were beginning to try and decrease their balance sheets on the debt side so they could stay in business, essentially. And we reached a point in 2016 where CapEx reached a near short-term low in terms of CapEx. The companies came out of that period with much better balance sheets and a need to look for more gold. So CapEx started increasing a little bit as they built more mines, but we're beginning to see the problems of lack of investment in current times or in the recent past. And so the CapEx is starting to increase a little bit, but companies are still a little shy about reinvesting in new discoveries and new mines, as you can see with the commitment to capital expenditures decreasing pretty significantly through 2030.
And by the way, to just mention it because we didn't emphasize this earlier, when we talk about the cost of mining, that and many people say, oh, it costs $1,000 to get the gold out of the ground. Well, what's at least as relevant is whether the mining company has the cash to develop it, because it's one thing to have a cost. Well, if you don't have the resources to do it, then you're going to go out of business. And so a lot, especially with the smaller companies, it is very relevant that they have the staying power. You may say, all right, my gold, I can get it out of the ground for this amount. Yeah, well, if you can't pay for the shovel to get it out, then you have a problem. Okay, well, let's switch gears. And is that a new chart? Is that the other one?
No, it's just one more chart. It's kind of showing a similar thing. The gray bars are the free cash flow. So the cost of developing the mines, or producing the gold, including the capital expenditures. So the free cash flow is the cash generated by these companies. And as you can see, from 2005 to 2018, the free cash flow generation was essentially flat to negative. And as the lack of further investment in new mines, you're seeing the increasing free cash flows over the next 6 years. The green line, again, shows the production starting to dip fairly significantly, and the corresponding decrease in free cash flow as production falls. Every ounce of gold that you're not producing is less cash flow dropping to the bottom line of these companies, and showing kind of the need for these companies to start thinking about increasing production in the later years, or at least looking for new sources of gold.
All right, good. So now we can switch gears. We'll switch gears to ASA, and ASA is a closed-end investment company as of April 12th this year. So just recently, Merk Investments, that's us, started managing ASA. And thanks to shareholder approval and all shareholders who are on this webinar, thanks for your confidence. And I wanted to, for those who are very familiar with it, wanted to give an update of what we do, what our plans are with ASA. And for those who are not familiar with ASA, I want to give you a first introduction. As I indicated earlier, there are various ways to invest in gold. Obviously, invest in gold mining companies is more volatile than the price of gold. Investing in gold mining companies in general is quite volatile. Investing in a diversified portfolio, it is maybe diversified within the space, but it is still a mining portfolio. And it is an actively managed portfolio. The portfolio is, as of April 30th, a little over 200 million in net assets, and it's trading on the New York Stock Exchange under the symbol ASA. Many closed-end funds trade at a discount to net asset value. ASA has been trading at quite a significant discount, almost 15%. And one of the opportunities that investors have in buying a closed-end fund is that you can buy the gold mining company at a quote-unquote discount. Now, that doesn't help you much if the discount stays where it is or increases, but it does help investors if that discount is reduced. And indeed, the type of investor buying ASA, it might be somebody interested in the price of gold or gold mining companies, but a significant number of investors are investors who focus on closed-end funds, and we have several of them here on the webinar today, and who are particularly interested how that discount is moving, maybe moving, and in that context, I hope we can be a little bit of help as far as the initiatives that we are undertaking. Do please read the disclosure here on the bottom as well. ASA is a bit of an interesting company in that it is considered what's called a passive foreign investment company. If you don't know what that is, the short of it is that you may want to hold it in your retirement account, because otherwise there are some disfavorable tax consequences that you might have. And we cannot give tax advice here, but if you have questions about it, you can drop a line and we can try to guide you to the right places. ASA was founded back in 1958 already, so it's a very, very old fund. It was founded in South Africa, and then it was reincorporated in Bermuda in the early 2000s, and it has been listed on the NYSE since 1958, and it is acting with a permission with the SEC as an investment company, so it is considered a closed-end fund, and it though has a very, very interesting history. Most notably, until recently, it was internally managed. Not many closed-end funds are internally managed these days. And what that means basically is that until recently, most things were done in-house. So the portfolio manager and the analyst team and the operations person, operations manager, and were employees of the fund itself. Whereas a more traditional setup, if I can call it traditional, or a more modern setup, is if one has an external manager. So we have an arm's length agreement. We are hired by the fund. The board approves the agreement, subject to shareholder approval. And one of the advantages and disadvantages of having internally managed structure, the challenge is that in an industry that had been declining for an extended period, obviously there had been negative performance. And so the asset base had been shrinking. Amongst other negative performance, there was also a tender offer at some point. And so then the fixed costs tend to increase if assets go down. And by having an external manager, one of the advantages is that typically, and in our arrangement as well, the manager is paid in basis points. And so with that, there is a more flexibility, making the fund more flexible, so to speak. Now, the argument in favor of internal management is, well, what about if the assets go back up? Don't you save costs with the internal management? And of course, yes, that can be the case. But I think it does go beyond it. When in the internal management structure, you have different incentives than when you have an external management structure. And most notably, and I don't want to put people to sleep with the arcane details, but there are several things that one can do as an external manager that and having a fresh face in there. One is on the investment process. Now, obviously, the investment process, you can obviously have a good investment process when you internally manage, or a bad one, and the same with an external management. But the advantage of being part of the quote-unquote Merk family, so to speak, is that we can take advantage of other things we do at Merk. Our research into interest rates, inflation, price of gold, and may help. And then obviously one of the things that may help, and I'll flip back and forth here between these charts here. One of the things we can do is we can leverage our experience in managing registered investment vehicles. Now, this may sound like an arcane topic, but managing a regulated investment vehicle actually does take a little bit of experience. And by having experience on the mutual fund side, that has allowed us to do certain things. So we started to talk with the board of ASA last September. We looked at whether we could help them, how we could help them, and had made proposals on how processes could be streamlined. And one of the things that we said is, well, if you work with the same administrator that we work with, Atlantic Fund Administration, that will help us to do certain things. And by the way, we have a good relationship with them. We can tell them if you provide service at a really competitive cost price, the odds are higher that the board will approve it. And of course, it is the board's responsibility to make those decisions. But what we have done is we have kind of shown them a roadmap on how we think that we can do this together with other service providers. And I'm very thankful not only to the administrator, but also to my team and also to the old team, to the previous internal team, to have facilitated a smooth transition. And if you think about it, if the employees are internal, it is a very different relationship to the board versus if the advisor is external. It allows the board to focus more on its traditional role. And if you follow the company closely, the board has shrunk to 3 people, whereas previously it was 5 people. And obviously there are several reasons for that. But you can manage this with a smaller board, which is a cost advantage, one of the small cost advantages. On the service providers, we've managed to help to get these services to be provided. I cannot say we, because it's the board that did it, but we helped to coordinate some of those things to put in places that now we have an external administration that's a full service fund administration, rather than having fund administration internally with an external accountant. And so there are lots of little pieces one can do. And the reason I mention all of this is because you can put ASA on a more powerful, more sustainable footing. And if you do that, and I hope if we can communicate it, I'll be glad to follow up with anybody who wants to dive into more details on that, you can show investors that in the long run, costs may be more contained. There's going to be a closer eye on the cost side. One big component of that is on the communication side. This webinar is an example of that. We are very happy and to communicate the sort of things that we do, letting the world know about ASA. Part of the reason we do it is because that's just in our genes. We have, as anybody who knows us knows, we like to communicate. And by the way, we're not raising money for new investors in ASA, but part of the reason we like to communicate is because we get feedback that helps us in idea generation. It helps us in other things. And so that's why we always welcome people to talk to us. If you're a shareholder or interested in becoming a shareholder, you're always welcome to talk to us. And then, of course, I should mention, and because I gave a very brief introduction to Peter Malides, we are very happy to have Peter, who you heard earlier, and you'll hear again in a second here, join our team. Peter was at Franklin Templeton as a gold mining analyst on their gold fund for close to 9 years. He has traveled in, I believe, over 40 countries. He knows the management of most gold mining companies. He knows the brokers very well. And those things are very important if you believe that active management with fundamental analysis is important. And to just make sure that is stressed, we provide continuity on that front, in that we are very interested in continuing to invest in, and maybe I flip forward to that, an investment strategy that has fundamentally a similar approach or same approach as the previous management had. Our emphasis may be different, but the idea of going into mining companies, a bottom-up approach, constructing a portfolio that way, that has not changed. Now, there are some changes that might happen, and maybe I pass it to you, Peter, some of the things that how you look at managing a mining portfolio. Maybe, Peter, I give it to you before I
sure.
talk you
through. So, yeah, no, as Axel said, I've been covering the space for a long time. I've done extensive due diligence on many of these companies, and have a base understanding and history with all of these companies that I can make quick decisions and have relationships with the brokers where we can make investment decisions that are very helpful to the fund. I believe that if you believe that gold is going to go up, that there is better leverage to, as I said earlier in the presentation, to some of the more growth-focused companies when you're on the mid-cap side, and believe that the portfolio should be more reflective of that. Some of the changes that have happened in the last couple of years in the industry have given me a lot more faith that these growth companies are being well run and are being more aggressive than some of the larger cap companies.
And by the way, to just talk about the quote-unquote quick decision. So one of the things that happens in this industry is that mining companies try to raise money. And a lot of people believe that a closed-end fund like ASA might be one of these providers of capital. And so those may be private placements, might be warrants, might be other ways that are issued. And so it is helpful, very helpful, to actually know these companies. So when you are approached on whether you want to participate when equity is raised, for example, on whether one wants to participate. So I think that's one of the examples where knowing the space is very, very helpful. Let me switch over here. The fact sheet, by the way, of ASA is available on the ASA website. It's asalimited.com, the website. You can also go there via Merk Investments, since we show that website URL down here. If you look at strategies and then gold mining companies, then you get to the ASA universe and you can download the fact sheets. These are two excerpts from the fact sheet. One is from last December and one is currently from April. These are the top companies that are invested in. And to just give a little bit of context, first of all, again, we're not recommending any specific companies. We just want to give you a little flavor of what's happening. We've obviously had some mergers in this industry. Peter's going to touch on those in a second. The goal is not to radically change the portfolio, but as Peter's pointed out, we are moving down the ladder to make the portfolio more dynamic. Historically, the portfolio has been, in our assessment at least, quite defensively positioned, and it's gradually becoming a tad more assertive. Now, that doesn't mean it's going to become hugely speculative. It doesn't mean it's going to be entirely exposed to on small exploration companies. But as we showed earlier on some of these, at least historic charts, some of these very large companies, they don't have less leverage to the price of gold. And importantly, if you looked at some of the other charts as well, they have, the reasons why there are such big mergers happening right now is they haven't invested enough. And so they need to acquire companies. They need to spend money. And we just a few days ago had an acquisition at a premium where actually we were a beneficiary, in the sense that the company that ASA invested in was acquired. But as the big companies need to spend money to replenish their reserves, we believe the mid-cap companies will benefit. So I'll pause here and hand it to you, Peter, to expand on.
Sure. So over the last 6 months, we've seen two significant mergers, one between Barrick Gold and Randgold, and that's part of the reason why the Barrick position in December 2018 was almost 16%. And then over the last couple months, at post the December 2018 fact sheet, Newmont and Goldcorp, who's down at 4.2%, merged to create. Both these companies are $20 billion companies, and they both represent close to over 10% each in most of the indices. And so it is our opinion that these mergers, while necessary for the industry and necessary for these companies, creates an opportunity for the indices to be dominated by these companies, but potentially not outperform, make it easier for active managers to potentially outperform the indices. And as these, in particular, as these mergers are integrated, the companies change management structure, and the assets are sort of looked at from a different eye, we will see a time period where these large companies could likely underperform some of the mid-cap names as they're more focused on changing the corporate culture and some of the other opportunities within the company. And therefore, there also will be potential for some of these large companies to spin out assets that will create opportunity for the mid-cap companies to buy them and get better leverage to changes in operations at these companies.
Right. Yeah. No. Great. And obviously, that underperformance is our opinion and our assessment, and who knows how it's going to happen in practice. But so before we open it up for Q&A, the active management opportunity, we often get asked, well, why not buy the ETF? And obviously, I'm not saying that one is better than the other. They all have different profiles, different opportunities, and the active management, in our experience and our assessment, provides a unique opportunity, and importantly, you can get these as a discount. And showing results as one way to reduce the discount is the reason I put that there in quotes is really because results on many levels. One is the performance. Performance in absolute terms may help. Performance in relative terms to an index. Now, grant you, the index, the benchmark that's currently used for ASA is a FTSE Gold Miners Index, which is a static index that now has a huge overweight of the large mining companies. And so that may need to be looked at on whether that is a suitable index to benchmark the performance against in the medium term. But results also with regard to many other things, continuing to implement best practices, continuing to communicate, continuing on the investment process side. You've heard Peter talk on several things that he looks at. At Merk, I'm the Chief Investment Officer, and it's my role to help in the kind of provide input on the risk management on anything and everything that we do. And just being able for the portfolio management team to leverage on all the resources we have, we think is going to be beneficial. And then on the small things, we'll try to save a penny here and there for the company as a whole. Peter, do you want to, before we go to Q&A, just give a brief elevator pitch as to why ASA might be worthwhile for investors to look at?
Yeah, no, I think the team, I think the way we're looking at this sector and with our positive inclination towards gold, I think there's a good chance that we could see increased leverage to the gold price for this portfolio by the way we position it. And the potential to de-emphasize the indexes that the fund is mapped against, I think will, just through performance, should significantly improve the potential for the appreciation in the fund, and hopefully, as Axel's talked about, reduce the discount just by our communication with the external market and with improved performance.
And of course, there's no guarantee we can reduce the discount, but we believe a consistent investment process, good communication on those will help to attract investors, and that then in return can help the discount. By the way, if you do need help, quote unquote, trading ASA, we're not brokers, but we can guide you potentially to the right people. And if you're not familiar on how to place trades, it's trading on the New York Stock Exchange, of course. But especially if you want to place larger positions, we can get you towards some market makers and whatnot. And then just briefly, obviously we do other things at Merk. Many of you know what we do. We have some investment funds. We do publish research, and lots of stuff you can find on merkinvestments.com. And these days we also can help select institutional investors and other large investors with their portfolios. So with that, Nick, do you want to take it to the Q&A?
Sure. And as we move to the Q&A, please take a moment to read the disclosure page. One question came up, will there be a replay? Yes, there will be a replay available in the coming days. Then a question here, I think this is referring to the slide showing the reaction of the different market caps to the gold price. Question is, do you have a minimum market cap when you refer to mid-cap miners? And maybe you could talk about the ranges for the small, mid, large cap and what the investable universe is for ASA.
Peter, do you want to take that?
Sure. Yeah. So on that chart with the beta showing the market cap, historically what we use is that's more of a production number. So the large caps are greater than 1 million ounces. The mid cap are below 1 million ounces, but typically above 100,000 ounces. In terms of market cap, the way I look at it as well is greater than 10, in the gold sector has gotten a little smaller relative to the general market, but greater than $10 billion is considered large cap. Between 10 and $2 billion is mid cap, and anything below $2 billion we consider small cap.
And then about in our investable universe?
in our investable universe, we will look across the board. Anywhere from, our kind of sweet spot is I would say more like 500 to $2 billion or $10 billion.
Yeah, and to just add to that, one of the reasons why Peter's not giving specific answers on that is because we want to retain the flexibility. Now, this is not going to be a fund that invests only in exploration companies, and the exact composition may well depend on our assessment and of opportunities. What we are communicating here, and obviously we cannot say what we'll do specifically tomorrow, but we have already taken steps to move more towards the mid cap because we think that there is good opportunity, and we may well have smaller companies there selectively. But the challenge with the smaller companies is, of course, that the liquidity in the market, even at a 200-some million portfolio, is less. And so there's a limit as to how much exposure you want to have from that. But that doesn't mean we can't ever participate in any of those. And so we are able to provide capital. Yes, and Peter, if you want to expand on that.
Yeah, no, and one other thing I want to mention is that one of the concerns that I have in the sector is the ability for the smaller guys to actually fund their project and their exploration. So we have a preference for companies that have strong partners and are already strong balance sheets before we look at them. The idea that companies will be able to raise money from sector funds like some of the bigger funds is not as, the possibility is not as significant because those funds have gotten a lot smaller, and the generalist investor has left the gold sector for the most part. So the ability for companies to raise outside funds, not from other companies or industry participants, makes it harder for them to go forward on their own.
Yeah, to just rephrase that, I agree with everything you said, but let me just rephrase that because not everybody is familiar with the space as much. Several years ago, the availability of capital for the smaller companies was far more significant. Nowadays, it's far more specialized. And so it used to be that companies, they raised some money, they used it, and said, oh, we need more money, and then they got more money. Well, as this industry has had a bear market for an extended period, a lot of these players don't have the resources anymore to provide the capital. And so at the same time, of course, yes, you need capital to do certain work. And so what we're looking for are companies that have a good plan, that have trusted partners. And then, yes, then one can chip in and help with that. But ASA is not in the position, and it wouldn't be prudent for ASA to have a mining company depend on ASA, because ASA's assets are limited, and then we'd give money, and then guess what? When they need money next time, if they need money again, then we can't provide it, they can't get it anywhere, and the investment is going to turn sour. And so that's the sort of mistake that has happened in this industry, and we're trying to address. Is that a fair way of rephrasing that as well?
That's a great way of saying it.
Yeah. All right. And he doesn't just say that because I'm his boss. Nick, go ahead.
The investment strategy says at least 80% of investments must be related to gold miners, et cetera. Do you have plans to pursue other companies that may not be related to gold?
Yeah, first of all, the 80% rule is something you'll see in every investment registered investment company, and so that just means that's the predominant thing that we are doing, will be doing, and that's what we say by mandate, and that's what we'll do. Now, beyond that, yes, the focus is on gold and precious metals. Peter, if you want to just say a word or two, what your feeling is.
So I mean, I have a preference for gold at this moment. We do have investments in silver and companies that have a decent portion in copper. And historically, the fund has invested in some other commodities. But again, we are more focused on the gold side. There's some platinum investments as well. But that being said, we are more asset focused than anything, and are willing to look at some other forms of precious metals. But again, the focus is gold, and that's the sector we like the best.
And that's the current assessment, and that may change over time.
Correct.
Yeah, go ahead, Nick.
How much of the significant loss in premium to NAV is due to the competition from ETFs? It looks like the biggest drop occurred when ETFs came to market.
Well, that's difficult to say, right? I mean, this is like trying to read the tea leaves on any market move. There are certainly various drivers, and ultimately, if one believes that the discount will always be there, well, sure, then you take that as a static line. Obviously, it introduces another level of risk, but at the same time, the flip side of that is it introduces another level of opportunity. What we are arguing is that fresh management with new ideas, positioning the fund more assertively rather than defensively, with better communication, with what we believe are best practices, and I can expand on some of the things we do without trying to bore everybody. We believe those initiatives all help to motivate people to kind of consider ASA. And if several people do that, then the supply-demand dynamics can shift and translate to a lower discount. We are under no illusion that that happens overnight. That's the process, and it's a process that we believe in, and we are committed to pursuing. And by the way, just to mention it, one other way that one can potentially address the discount is by having a tender offer. That has been done in the past by many closed-end funds. At times, it does temporarily reduce the discount. The challenge is that you don't want the fund to get so close, so small in doing that, then that's no longer economical to manage. And that's one of the challenges that of being at where we are right now and making a tender offer a far less attractive option than it might be if it were a fund of several billion dollars. Go ahead, Nick.
Do you have a max all-in sustaining cost level you accept for selecting a miner, for example, $1,000 or some other level?
Peter?
No, we don't. I mean, I won't say that, but the part of the analysis is looking at the current all-in sustaining costs, which is a moment in time, and over time, that each year that potentially could get lower. And so the higher the all-in sustaining cost typically would give you better leverage to gold. And if the trend is in your favor, that could potentially make it a good investment. But again, it's part of the analysis, and we're hoping that the all-in sustaining cost is going down rather than up.
And to just add to that, the more important thing is that a mine has the resources to execute its plan. That's really the cost doesn't matter if you don't have the money to execute on the plan. Is that
or the team to make
exactly.
affect change.
Yeah. All right, Nick.
You had a couple charts relating to valuation metrics. I think this question is in relation to that. At what free cash flow yield or dividend yield do you see generalist investors returning to gold producers?
Peter?
Well, obviously every fund manager has their own bogey for what they're looking at, but I will say that the number that seems to jump out for a lot of people is 10% free cash flow yield. So at that point is when people start getting a lot more, the generalist investor will start to get a lot more interested.
All right, Nick, one last question.
Sure. Okay, so please apply your outlook on gold to prior times when the economic situation was interpreted to be similar to now, and describe how precious metals markets responded in those environments.
All right. Well, how many hours do we have? That's an interesting question. I mean, in some ways, of course, the current situation is unique. We've never had a central banks around the world who's done what they have done. We've never had such an integrated global world. But at the same time, we've rarely had such a belief that inflation is too low. So there are many unique things. What is similar to other periods in history is that governments have overextended themselves on the fiscal side for numerous reasons, be that entitlements and whatever that topic might have been called throughout history, be that because of military engagements around the world. And in those sort of environments, historically, the currencies have kind of been devalued. Now, over time, I mean, the Romans did it by debasing the metals content and otherwise, right? So those sort of things have happened before. We haven't, and then this environment that's people say, hey, the Phillips curve is dead, meaning that meaning that when you have very low employment, that inflation is not going to be a problem. Well, it hasn't been a problem. Does it mean it will not be a problem ever again? I don't buy the story that, quote unquote, this time is different. Now, we've had the one thing about, we talk a lot about mining companies having access to credit. And for many of you may remember that in the aftermath of the financial crisis, the one thing, yes, you get the leverage with the mining companies, but the one thing that many junior mining companies in particular are dependent on is access to credit. And so that's why a lot of people were frustrated they didn't get the sort of leverage. One of the things we're arguing is that the cost base has been adjusted with many of these mining companies. They're more conservatively run than they have in the past. Now, some mining companies might get aggressive and overpay when they acquire companies, so obviously one has to be careful on that front. But still, from that point of view, those are some of the differences, right? And so every environment has some uniqueness to it that provides unique opportunities, and it's one of the reasons why we believe that with active management, one might be able to add value. So
I'd like to add one thing, is that maybe specifically to this, some comparisons that I've looked at, is that there's been a couple of times when the real rates have dropped below 2% for a sustained period of time, and you could look at 1970s and then say 2004 to 2011, where the gold price, where the yields were at this level and the gold prices took off fairly significantly. And then also another point would be where the yield curve has inverted like it has always been a pretty good precursor for gold price increases. And the most recent time we saw that was 2006. Gold was at $550, and then between then and 2011, it went up to $1,800. So again, we seem to be in a period. I'm not going to claim to know when this could take off, if it does, but they have historically been good indicators of a potential increase in gold.
Yeah, and so with that, anybody who would like to dive into more detail, feel free to reach out. But Nick, if you want to wrap it up, in the meantime, I thank everybody here for participating as well. Nick, go ahead.
Sure. Thank you again, Axel and Peter. And if we weren't able to get to your question, or if you have any additional questions or comments, please use the contact section of the website, asaltd.com. This concludes our call. Thank you all for joining us.